people who take the risk to join a company early stage, especially if they're taking below market average salary, should be compensated in other ways. And I think ESOPs presents a great way to align that interest.
Being an entrepreneur is not a short-term path, it's a marathon. So I think it's important to have alignment in equity, always.
You should not go to your board and be like, hey, look, I'm heavily diluted. I think I should have more equity. That's not a good reason for you to have more equity. You need to go to your board and be like, look, I'm killing it.
This is one weapon in your arsenal. How do you use it well? That all really comes down to the founder.
What is an appropriate amount of equity to sell if you're a founder where you don't want to send a negative signal to the market? I have a number in my mind. I'll let you say yours first. I like how we're connecting multiple continents right now, right? And I think it's good because we're getting also a global perspective when we look at this report. Chin, you're in Singapore, right? So you're up early this morning, and Gustavo is in Brazil, in Sao Paulo. So, and I'm up in Northern California. So we've got a three, kind of the triangle here of opportunity. And I'm looking forward to this chat. I'm glad that someone finally kind of dug into the stock option. And so I'd love to start off, maybe share a little bit more about the idea behind the study. Give us a quick breakdown for those that aren't aware of the study. Where did it come from? Why did we decide to do this?
Chin, I've met was like a year ago. And he can comment a little bit on Credit Saison, which is a beautiful platform that started in Japan many years ago. But Chin has a background of a founder, an HR founder from Singapore, and he runs the CVC of Credit Saison. He can give some lights on that. And last year, they landed in Brazil, Credit Saison, and they were one of our first institutional investors at Latitud. So we have like this powerful CVC backing us here, which you know how important it is for our business to thrive, having the international community investing and supporting us. We were talking about content creation, in different sectors like Web3, fintech, some trends in the market. And this report, he has made it in Southeast Asia. So I said, why don't we bring your knowledge and your background that you have done in Asia? Why don't we replicate that to Brazil, to LatAm? Because I think it would be very important. And given the number of companies we have in the portfolio, kind of that's how the idea came to life. And then we started to kind of talk back and forth. And we invited Caravela, which is a close friend of ours, to help us on the research and to build the report that you saw last week.
Absolutely. And maybe jumping in here, so I'm Chinan from Credit Saison. We're super excited. The story for this ESOP report actually started 3 years ago, right at the peak of the bull market. At that point, we were trying to get an understanding of how employee stock options could make life-changing wealth, right? For many people, many employees who took the risk of joining a startup early. So we launched the first report, and it's the first of its kind in Asia. So over the past 3 years, we have more than 100,000 downloads of the report. This year, we thought of refreshing the report in Asia to say, okay, of course, the market has changed. We're no longer in 2021. So what does the state of ESOPs in Asia look like? And then, of course, that was when we spoke with Gustavo, who said we should do exactly that in LatAm. Because once again, it's quite unique, right? Today, if you want to find out cash salary components, there's plenty of benchmarks. You just Google, let's say, average BD salary in Brazil, and you get a lot of data around that. But there's no such data for employee stock options, right? If you Google, how much should I get if I'm employee number 5? That you don't really have that benchmark, you really don't have that reference. So we really wanted to put together this report to serve as a reference for the tens of thousands, if not hundreds of thousands of startup employees in Brazil, in LatAm, so that they can be more educated when they speak with founders on ESOPs.
The information out there is available on salaries. And, I think it's helpful for founders. It's helpful for team members that are joining companies. They should kind of get an idea of the more transparency you have on these things, just the more kind of effective the market is. So, I'm glad that you brought that to the market. For those listening, I'm going to assume that everyone knows the importance of having equity. I think it goes without saying that, you're creating a mentality of ownership because there's true ownership. And I can say from my journey at Vivaral, I remember the day I got to call an intern that worked for us and tell him to send me his bank account information. I wired him a few $100,000 and he could buy a house. That was like a pretty special moment for me. Multiple people that were able to do that, and they started angel investing. They started creating some wealth. And so I think that the obvious idea of creating alignment with your team and having people just ultimately be more invested in the project is great. The study shows that most startups allocate between 5 to 10% of their option pools. So what is the optimal pool size considering both founder dilution? How would you guys advise those early stage, let's say, a new company is starting? Do you start that right when you start the company? Do you wait till you negotiate with investors and then create it? What's kind of the best practices there?
Latitude, your podcast, you have a large audience across LatAm, but I think a big majority of them are perhaps in Brazil. So maybe I just throw out a couple of quick stats out of there that might be helpful, especially for that. And this is exclusive, by the way, so it's not in the report. I'm giving you guys exclusive
Great.
content.
We like
here,
that.
right? What we like is that what we see is in Brazil. Brazil actually, unsurprisingly, has the highest adoption of ESOP across LatAm. We're talking about 9 out of 10 companies in Brazil that actually have ESOPs. So we think that's excellent, right? That's quite commonplace, and really it's because of leaders like yourself, Brian, that set the precedent. Is really like top investors like Gustavo that really encourage founders to do it. So we see very strong adoption of ESOPs in Brazil. But I think one of the biggest issues, which is also the biggest gap, I would say, that Brazil has, Brazilian founders have, it's when it comes towards tax, right? We know tax is complicated in Brazil, but when it comes to ESOP tax setup, less than 20% of Brazil founders say that they understand the tax implications of ESOPs. So in my mind, this is a little crazy, in fact, because what you're saying is that people are setting up ESOPs, and these ESOPs could be worth millions of dollars or even more, right, when a company succeeds. But founders themselves, they're not familiar with tax setup and all of that. And if the founders themselves are not familiar with tax, what more do you expect from the employees, right, who probably know even less? So really, I think what we're seeing is that, yes, there's something to celebrate, which is ESOPs is very commonplace in Brazil in particular, especially across LatAm. But I think there are, of course, areas for improvement, and that starts with understanding tax implications.
Compliment Chin here, Brian, and I will bring this kind of a more legal point of view that you brought, Chin, which is, first, the reason why I think we are very educated, or the founders, like you were impressed that they have adopt ESOPs. I think that is first. I think that we have some good law firms and like that is standardize the rounds and the market, right? We have seen that, so it's kind of when the founder comes to start a company, he has that playbook of structuring already, flipping the company abroad, structuring a proper safe instruments, the ESOP around between 5 to 15, I would say, Brian, usually prior to Series A, give or take. So it has become kind of a standardized process if the guy wants to raise capital from the top leading funds of the industry. Not only that, they know they need to build that in certain ways, not only to attract talents, but also to attract good funds when it comes to growing the company and raising more capital. So I think that's one side of the equation. Another thing that we've looked at it, the legal framework in Brazil, it has been very pro-business in some areas, like similar to US. And very recently, there was a ruling, a positive ruling from judge, was like September this year, where they telling that they understand that the stock option plan should be tax treated as like a commercial transaction rather than a salary income, which changed a lot. Because imagine if you have to pay tax of something that you haven't got the cash yet. So there are some trends and information to help out on that sense. So I think I want to bring some of that to shine. I think people should look at it into that. It's very new, but I think that's going to help a lot. Like you say, not only the companies, but in the founders to really understand the power of the stock options,
Came as a bit of a surprise in the report. 85% of LatAm startups have implemented ESOP stock option plans, and it's higher than other regions like Southeast Asia. Why do we think the percentage is so high? You said Brazil is even higher than the rest of Latin America, so Brazil must be above that. One, how does that compare to the U.S.? Like, what's the data in the U.S.? Where do you think this should go? What do you think an ideal state would be for Latin America?
Yeah, to be honest, what we're seeing is basically Brazil has pretty much the same adoption as mature markets like the US, and that's significant, right? Because I think the markets are also radically different. Of course, I think one thing that still has room for improvement between markets like Brazil and US, it really comes down to liquidity. And I think this bears no surprise for all of us on the call, not just for ESOPs, right, but also for all three of us as investors, that, of course, the liquidity markets are a lot stronger in the US. But I think that's something that it's a matter of time, right? I think it's a matter of time. What we're already seeing is more and more of these liquidity events, more of these ESOP buybacks. So that's something that we are optimistic about.
What's your thought on that? Like, if there is an opportunity to sell, in my case, I let some of my senior management take some money off the table during a couple rounds. What's a fair thing to do? Is it something that you make available to everybody? Is it something you kind of handpick the top performers? Like, how would you advise founders to think about that?
That is not a straightforward question. Ideally, you would offer to the whole company as an incentive, but it really depends on the company. Sometimes on a more early stage, you end up offering to the senior level, right, as an incentive, because you got to track them, and usually those guys have a bigger package outside. So in order to attract them to jump into a early stage company or an idea, that's how you blend, small salaries with an upside on the package. So I think when you're smaller, it's like a earlier company, you end up starting with the senior layer on the ESOP. As you grow, you start extending the plan for the company as an incentive, as a part of the culture. I think, that would be something that we look after, and we see the evolution of the company in our portfolio, for example.
Generally speaking, Latin America has adopted stock option plans pretty effectively, and it seems like it's a tool that's used by founders to recruit top talent, and it benefits team members that are part of growth stories because they can generate much more personal wealth if they can be part of a success story. On the other hand, only 20% of these startups extend stock options to all employees. So we mentioned liquidity. Obviously, that's a harder subject to manage because that depends a lot on the interest in the stock, actual liquidity of the stock. In my case, I don't think we gave every single person stock options at the time. And I think my role models were like Mercado Libre, which was actually pretty stingy on stock options back then. And I think that I was like much more generous than what the founders of Mercado Libre did. And partially it was because there was a lack of perception of value and education about stock options. Clearly today, with the success of companies like Mercado Libre, Nubank, and others that, where the stock is actually liquid and people made money hand over fist, it's easier to lure people in with the idea of creating more value. Is this something that you think, like, really specifically, salespeople oftentimes like cash in hand? They like money. Do you think it's a good idea to try to force a salesperson to, take equity if they really like, they can't eat equity sometimes? So is the answer it depends, or is there kind of a philosophical approach, Chin, that you think that you've seen that you think is a best practice?
Look, at the end of the day, I just believe in this principle that people who take the risk to join a company early stage, especially if they're taking below market average salary, should be compensated in other ways. And I think ESOPs presents a great way to align that interest. I don't think it's necessary that everyone gets ESOPs within a company. And I think it sort of depends on what kind of company you're building, right? For example, if you're a company that, let's say, hires a large blue collar workforce that, churns very quickly, then probably it doesn't make sense, right? To give everyone ESOPs. But I think at the end of the day, it's really about for each founder to reflect, to think about what is their talent attraction and retention strategy. and not to be too stingy, right? I think to be strategic about, at the end of the day, what you're trying to do is to increase the odds of success of the company. ESOPs is one of the many tools, but a very powerful tool you have in your arsenal. So how do you want to leverage it? How large do you want to give? I think that's all strategic decisions that you as a founder can take. But it really has to be something that's well thought through.
I'll share my perspective real quick, which is oftentimes in the beginning, I was so all in on my company and I was just like, living and breathing the company. And I remember when I would recruit folks, I would give them an option of higher equity or higher salary, and they would kind of have to choose one. And that was used as like a negotiating leverage where it's like, hey, you can take this salary or you can take less equity. And I remember always feeling like I was judging the person that took less equity until later on I realized that, okay, I guess if you have kids, circumstances that don't allow you to live on a budget. So how should founders be thinking about that? What's the general advice that you have? Does it mean that people aren't as bought in if they don't take equity, or is it a personal lifestyle choice?
I would say that when I'm investing in a founder, I think it depends a lot, Brian, of the responsibility and the role that people that you're inviting or the team that you're building you want to have. I think it's becoming an entrepreneur. It's not easy, right? And you need to do the balance that you said. But I think that if you're bringing people that you want to by your side to build something which takes long to build, because being an entrepreneur is not a short-term path. It's a marathon. So I think it's important to have alignment in equity always. But, that depends on the level of the people. I think we always look at the senior level team, the co-founders and the founding team. I think that are areas that, the stock option, it's needed and it's important for both sides, for the founder, the majority shareholder, and for the minorities or the ones that you're going to attract with stocks. So I think it's a combination of them. You need to have that kind of alignment, because otherwise, it creates this alignment among the management team, in my opinion.
What do we think about the typical vesting schedule? Is it arbitrary that it's 4 years? Why is it 4 years? Is it because someone said it was 4 years and then it takes 10 years to build a company. So why aren't stock option vesting schedules 6 or 10 years?
Look, my take is it just has to be, it's just market standard, right? And to your point, I think there also needs to be a balance between long-term retention and sort of being unfair and sort of infinitely locking people up. I think, to be fair, we live in a day and age where someone who is with the company for 4 years is probably one of the longer tenured employees already, right? So I think sort of that 4 year is more of a market standard. And look, you don't need to follow it as a founder, right? But I think if you don't follow it, then you need to have good reasons to sort of explain why. Maybe you compensate for it in other ways. But it's just one of those things that I think in our report, it's something like more than 95% of startups adopt this 4 year period, right? So if you choose to be the exception, then sure. But you just got to be aware and be very conscious about it.
Yeah.
And with the 1 year cliff, right? Usually you need to put the cliff on the first year.
Yeah. Yep. Yeah. Yeah. I've been kind of personally feeling like 6 years is more appropriate these days, just because I think that it takes so long to build a company. And you see companies that bounce around for 3 years and then they like figure it out. And by that time, if someone leaves with 75% of their equity, it's dead equity, right? So that's something I've personally been reflecting on. Let's talk about absence of a longer vesting schedule. Let's talk a little bit about follow-on grants. What are we seeing regarding follow-on grants, and what is kind of the standard best practice for team members when someone has vested their entire grant?
So maybe I'll just say that for follow-on and for top-ups, at the end of the day, it comes a lot down to investors. Because when investors come in for the next round, they are the ones who usually say, okay, you need to refresh, you need to top it up. So I'm curious to actually throw it back to both of you, right? As sort of like the leading LatAm investors, when you think about founders and perhaps at the next round, so after the first round, do you ask for top-ups?
Sure. I'll give you my perspective on as a founder, and then also as a CEO of a company, how I used to think about retaining talent and compensating on an ongoing basis. As a founder, I think that, look, my advice to you as a founder, if you're listening, you should not go to your board and be like, hey, look, I'm heavily diluted. I think I should have more equity. That's not a good reason for you to have more equity. You need to go to your board and be like, look, I'm killing it. I grew 138% last year, and I improved the margins, in 30%, and you've got really specific KPIs. Then you ask for a top up. And the way I kind of think about it, there's a couple different approaches. One, you can have maybe a larger grant, but at a higher strike price. So potentially larger equity at a higher strike price. And that would give you potentially more upside if you think that you can grow the business in 5 to 10x. Or if you take the 409A valuation, which is typically at a lower strike price, maybe a smaller grant there where there's like built-in value kind of instantly. Those are two ways that I kind of think about. These are recollections of my conversations with fairly senior board members that had been on boards of public companies and successful startups that got big. And those are conversations I remember as a founder negotiating those things. I don't know. What are your thoughts, Gustavo?
We've seen different conversations, like, I think where our portfolio is growing now. It really depends. I think you mentioned something that is very important. It all depends on how the company is going, right? And what the guy is doing, how, sometimes he started without that knowledge, right? And then he gave a lot of equity over the years, and he started. When the company is really killing it, he's too diluted, and it's fair that we refresh it, But I think that is not a rule. It's really a matter of how that guy or the CEO, the founder, the co-founders, they are committed to the business. Because if they're killing, if they are doing all they can, and maybe they took some hard years in the beginning, it's fair that as funds, you kind of you understand that, and you incentivize the guy to take another 5 to 10 years, leading the company. So it's case by case.
Yeah,
we've seen,
Yeah, I think a lot of it depends on the stage of the business, and the truth is, like, no board wants to replace the CEO. So that's not a fun task, and there's obviously. I've coached a handful of founders that have been in situations where they've got heavily diluted. And I typically, first thing I tell them is to focus on your performance, don't tell a sob story, because investors, they want there to be rationale. It's the same thing if an employee came to me as CEO and asked for, hey, my personal expenses have gone up a bunch. I'm sorry, that's, you gotta, separate that. I would say for the CEOs listening and the founders listening that are managing senior executives, what I typically advise founders is for the top 20 to kind of 25%, you can be fairly aggressive. So that's like the top performers in your company. Like, don't mess it up with your top performers. Reward them. Be generous. The way I like to think about this is my advice, and it's not the best advice given that I'm talking to two investors. And I'm a third investor here. You kind of want to be stingy with your equity with investors, and then you want to be generous with your team, because the reality is the team is going to be the one in the trenches building with you. So I like to call it layering. So what I typically do is after 4 years or the vesting schedule is ended, I typically do a follow-on grant that's normally between 20 to 30% the size of the initial grant. And I layer that in between 12 to 18 months. And then you've got layering. So you do that a couple times.
Amazing.
Now you've got these things stacked up over time, and the motivation is kind of like extended for some time. So those are the typical kind of, at least based on my experience, what I typically do or advise founders. Let's shift gears a little bit. I'm sure there's a lot of juicy stuff in the report, so we won't go deep into all the tax stuff right now. We touched on it a little bit. It is surprising, Chin, that you mentioned that 20% of founders, you said, feel like they are more confident in the tax thing, which, is kind of mind-blowing, because that means 80% of the people are giving these things out and they're not understanding the implications of it. In the report, is there very specific things that people can follow? Because This is the last thing you want to spend your money on as a founder, is like hiring a bunch of law firms and running up the tab there. What kind of tactical advice do we have for founders besides just go talk to a lawyer? And by the way, this will not serve as legal advice, just for the record.
Yeah, actually, that's a huge motivation for why we did the report. It's really because we wanted to uncover what the market benchmarks are. Because look, to be honest, when you are a startup, where you have limited funding, all you have to do is to sort of be resourceful, right? And we want to create one of those resources, which is this report, that unpacks what are all these issues that you need to think about when it comes to ESOP. So really, I would say definitely read through the report. It's more than 50 pages long. It goes through a lot of those things. And I think it's all about timing, right? So of course, if you're a pre-seed startup, you only raise a couple 100,000, it doesn't make sense to hire a tax or even a lawyer to set it up, right? Something that's a simple agreement on a one-page Google Doc, both sides sign it off. I think that suffices, right? But as the company matures and as you start to get to price rounds, you start to raise more capital, then I think that's when you should properly look at getting the plan structured and getting all of these things in place. So I think it's always on a journey. We're not expecting people to spend half of whatever amount they raise on to set just the ESOP up right away, but really is something that they should keep a close eye on.
One thing that I recall that I think is challenging sometimes is at the early stage, this is a cautionary tale here for founders that are negotiating those early hires, and you're talking in percentages. Because this gets a little tricky when you stack up a bunch of safes, you talk about percentages, and then when the safes convert, you do a price round at a different valuation, percentages can really change quite a bit what the intended amount of stock you are giving out. So I think that's just ideally you can give information about percentages if someone asks, but my advice to founders is like, the reality is it's number of shares at a strike price typically, because when you start talking percentages, that changes as the value increases, right? Like you don't want to keep the same percentage when the company is tripled in value because you're giving away, kind of equity unnecessarily. So that's one thing that I would kind of caution founders to look out for when they're, any other cautionary advice or things to avoid or be aware of that you guys can think of?
I like adding on what you guys saying. I think try to be like Chin said, like try to be simple, right? Try to be transparent. I think that is an education process that I think we mentioned that a lot in the report, because like try to simplify things like you mentioned, like, instead of percentage, number of shares. I think those small things, it really brings a more clarity and understanding for all. One of the things that we also advise in the report is that sometimes use, Comp, which was one of our partners in the report, or Carta, or like systems that nowadays you have tools to better understand, and try to over time, improve this transparency to the employees and to the company. I think that helps, using those. There are some technologies and some platforms that you can use to help you out with that. So I think that's one of the advice that we also share with the within the report that we wrote.
Yeah, it's great to share the progress of the company. Like they're not technically shareholders because they just have options, but you want to treat them like shareholders. And, if you don't share all the success and then, the positive news, it's like the value is almost forgotten, right? That's one thing that I think a lot of founders forget about is like they know in their mind the value of what they're building and they're excited about the future. But if you're a team member, it's like it's not always top of mind and present. So you've got to kind of educate on the progress of the company. How is this going to affect the potential value? If we can execute and get to 10 million ARR, this is going to have an impact on the share value, and that's going to essentially be more wealth. So I think there is an educational piece. One thing I'll share as an anecdote, I remember when I was negotiating the first time with an investor, and I didn't understand this at all. And I remember I had this little spreadsheet that I'd created, and the investor was like, "No, let's make it a 10% option pool, or I can't remember what that, or 20% or whatever it was." And I would be like, I would plug in my numbers in my spreadsheet, and then I would see the share price would drop, and I'd be like, "Oh shit!" I think this is one thing that founders should be aware of is that when you're issuing, shares, like you're essentially like decreasing the value of the company. So when you're negotiating with investors, So as a side note, like, how should you think about the size of the pool based on your kind of hiring plan? Because it is, again, kind of arbitrary to say 10% or 15% or 20%. How much should it reflect the future plans of hiring senior folks? Because if over the next 2 or 3 years, you only have a couple key hires to make, what's the point of having a 15% option pool during that time?
So here's maybe once again a bit of alpha for everyone who listens to the podcast, right? And this is sharing sort of not just from the report perspective, but also my experience of being a founder and one also in the HR space. Firstly, there is value in ESOPs, in a sizable ESOP pool, because unallocated ESOPs usually goes back to the founder. So if you want to think about managing a dilution, that's a great way of actually getting back some, right? Of course, it cannot be ridiculously large. So for example, our report shows the market standard that usually 15%, it's sort of like the ceiling. If you decide to create a 20-25% ESOP pool, you better have a good explanation for that. Otherwise, your investors are going to start asking questions, right? So I think that's one. The second thing to think about ESOPs and a smart way to do it, it's not to communicate to employees in terms of percentage. Because if, look, today, Brian, Gustavo, I tell you, guys, I'm going to give you 0.1% of my company, you'd be like, what the heck, right? Like, I mean, what, 0.1%? Like how much must this company worth for me to buy my next condo? But instead to really communicate in terms of, let's say, the number of shares and the potential share price, right? So I think that's something that's a lot more useful and still a lot more concrete. So instead of saying, hey, I'm going to give you 0.1% of the company, which sounds extremely small, one thing is like, I'm going to give you 1,000 shares, right? Today, these shares are valued at $1, but this company could grow and look, that like the share price, we could see it being like 5x, 10x, not within the next 10 years, but actually within the next 3 to 5 years, right? And that creates good potential monetary uplift or gain for you guys. So once again, I think really comes down to being smart about these things. These numbers, like whether is it 10%, 15%, these are just all market benchmarks, right? But to be able to use this to your advantage, once again, going back to the analogy, this is one weapon in your arsenal. How do you use it well? That all really comes down to the founder.
That's great advice. First of all, if you're listening and you haven't downloaded the report yet, you should do that. We'll drop a link in the show notes for you to go take a look at it.
In the end of the day, getting stocks, it's a valuable thing, right? And one of the things that we are looking at it, how about the liquidity. I think events that you can sell a piece of them, so that the employees, they see the value of it. So I think that's something that we spoke about that during the launch event, and like how important it is to structure properly, like, okay, the 10, the 15%, that whatever it is, which is like the average, and being smart on giving that to key persons. But eventually, once you have the 4 or the 6 year, vested program, when you have up rounds, that you bring programs that these employees, they can sell a piece of that, so they can actually see the value, the tangible value of that. I think those are things that we incentivize, over the life of the company, because I think that's very important. Also, so other, founders, new founders that are coming to the market, they see, if you're growing well, if you're producing a beautiful company, if things are, are the way you'd like them to be, that is money in the table, because otherwise it becomes just a bunch of equity, you have a huge paper money, but you don't realize it. So I think making this tangible, I think that's something very important and something that we really incentivize when the company gets to that level,
Yeah, I agree. I remember the first time I bought a car and a house, and my wife was like, okay, this is real. I believe you now.
Exactly. And if you think about it, we haven't tapped into this conversation, but that's something, definitely a subject that I think you should definitely bring up here, because the content here is always amazing. It's secondary markets, right? It's in Brazil, in LatAm, it's very, very little. There's almost no secondary market, secondary transactions, because sometimes you lack of the information. You don't know what kind of type of stocks you're buying. You don't know the leak prep, the stack that you have. How there is no transaction to be made, and I think building these plans, and over time, when you start seeing these secondary markets too. I think that's going to it's going to evolve. US is a totally different market, right? It's a totally different beast. I think that's something that we should, it's information that is very important. And I think that is a market that has to be really developed. So
it's a very difficult, I'm not confident in the ease of creating a secondary marketplace. There's been a lot of tries in that all over the US and the world, and it's been very difficult. But I do think that bringing in more investors that are secondary buyers, Industry Ventures is our anchor investor in our second fund.
Okay.
And they pioneered the secondary, investment market from, the early days. And, they've been around for 25 years. So they've been doing this for quite a long time. And I do think that the more activity and more funds that, can come in and provide a little liquidity for the early investors, and it makes sense, and it's good. It's good for those pre-seed investors like us, right, Gustavo? Because that it's nice to show a little DPI. I know our investors like it when we send them money back, because that's part of the reason why you start a fund. So it serves a couple different functions, I think.
Yeah.
And there's different risk profiles too. Like if you're a founder and 95% or 99% of your net worth is tied up in your company, what is an appropriate amount of equity to sell if you're a founder where you're not, you don't want to send a negative signal to the market. So I have a number in my mind. I'll let you say yours first. I'd love to get your perspective on that. What's a reasonable amount of money to cash in as a founder, selling your equity?
Which round?
Yeah, I think in general,
Series B?
Probably like something around the Series B is more typical, right? To sell Series B and Series C. I first sold in Series B, and then I sold more in Series C.
Yep.
Series A is you're just ramping up, and it's probably, if you feel excited about the business, you feel like you've got, you're going to 5x it, 3-5x it, and then in the following year or two. So what's a good amount of cash to put in your pocket where it's not like you're going to be sitting on a beach, but at the same time, you're able to, buy that house? Love the investor perspective.
I would say that when we see it all falls into the founder and the company, but a guy in Series B, after, let's say, 4 or 5 years, working like a mad dog, going through all the challenges that is to be an entrepreneur in Brazil or LatAm. And I would say $1 to $2 million. I'm not a percentage. I prefer to refer to value. It's a good number for one first cash out to buy a house. I would say that it's something that I think it's fair. It doesn't change the life. The guy's not gonna crazy because of that, and give some comfort so he has kind of peace of mind to keep grinding.
That makes sense. Chin, any other thoughts?
Yeah.
How would you feel about a founder? You've been in the founder DNA, and then now you're more on the investing side. What do you think an appropriate amount or percentage is?
I think just off the top of my head, 10% or less is fine, right? That's the kind of thing that no one would raise an eyebrow. And I think, secondly, it must be the company is doing well. I think Gustavo and mentioned that, right? So if this is sort of like a save the company round, so absolutely not, right? You're definitely not taking anything out of it. And once again, if the company is absolutely crushing it, then of course maybe you have the right to ask for a bit more, right? So I think really sort of comes down to that balance. But in my mind, single-digit percentage would not raise an eyebrow. Maximum tops out at 10. Anything higher people start to ask questions, right? Yeah.
We're on the same page. I was thinking single digits, and then in a stretch scenario, 15% if you're just absolutely crushing.
Yeah.
But I would say 7 to 10% was my kind of number.
Yep.
And I think that's super reasonable. And that could be a fair amount of money depending on how valuable the company is. But it most likely isn't an amount of money that's going to just put you on the beach somewhere and remove all motivation, probably you're intrinsically just powered by your mission anyway. And so it just provides a little security for your life, which is a positive thing. So if founders, I remember the first time I took money off the table and I was sitting at a dinner and there was 10 other founders and they were all like, how did you do it? What, tell me about the details. Fortunately, that's like a little bit more common now and it's not as taboo as it was when I did it, which is a positive thing, I think, for the healthy, environment of being a founder and not, absolutely just killing yourself. You should be able to not have to think about buying something nice for yourself or being in, a nice house, or those are all things that are additive to your life. Well, anyways, guys, thanks for the chat. I think the first time we've kind of peeled back something that's so important in building wealth. I think this is an absolutely fundamental part of, building the future of the region. There's, if you look at the value of the most valuable companies, they are the tech companies, and the future, we all know where that's headed. If we look at more mature markets, this is, something that's happened. It's already starting to happen in Latin America. And so we want just the people that are helping build these stories to be part of the, the generational wealth that is created, because that's, that creates a lot of positive dynamics for society. And so I'm excited to see more of that happen. And then there's more reinvestment back into the ecosystem, right? Which it's a flywheel. And so it's exciting to see. And so I'm glad you guys shined a light on this, and we'll make sure to get this out in our next newsletter as well, so that we can spread the word about what you're doing.
Thank you. It was a pleasure to join you here, and thanks for the invite. And let's keep investing, keep building, right?
That's right. Vamos LatAm. Thank you. Appreciate it. And we'll be in touch. All right.
Thanks, Brian.
Take care.
Bye-bye.
Good one.